yesterday. For anybody that's been long from here, they'll probably start trading the stop loss somewhere around here. Nobody in the right mindset would leave the stop loss here, except hedge funds. And while people think hedge funds are smart money, they're not really smart money, right? They're rich money. They're dumb actually. They're not trade. They enter here, they put a stop loss somewhere here. Hence why when we see recession, we go a little bit more down. When we see recession, we go a little bit more down because retail will put a stop loss here. But the actual hedge funds are rich enough to have a wider stop loss, right? So they will put it normally 10 to 20, 10 to 20 ticks away on NQ on ES, just a few points. All right. So if they put it here, from here to here would be about 10, 12 points, etc., etc. So hence, in this case here, this is the previous session. It's about 5 points, so 20 ticks, even roughly. They'll put the stop loss somewhere around here. That's why we get a continuation move up, not just an immediate. Like for example, here we just rejected, we swept and continue going down. But here we took the retails, but the actual hedge funds will leave their stop loss in this blank space somewhere around here because they're rich. And if they get stopped out, it's no problem. They can re-enter again. Retail will not. Okay. So for this entry here, there's multiple entries you could have took, and I'm going to go over some of them with multiple concepts, including our strategy. So basically, our strategy would have just gave you sweep, charge, FEG. This is the FEG, right? Touch. Just stuck in the FEG and continue up. This here is the IOEFD. Sorry, institutional order flow, IOFED. Institutional order flow entry drill. Okay. What that means is that we just touch an FEG and continue up. We don't fill it, we just touch it and go up. Okay. This is an algorithmic signature, a very powerful signature. Also, before I will go into the details, but here we have a low, lower low, higher high. This green candle here, the highest green candle from this low to this low is this green candle. We look always at the bodies, not the wicks. The bodies, the highest body of green candle is the candle we use for our breaker. So this is a breaker block, FEG. What do we call this? We call it unicorn entry, right? Here we have a drop in the price. We have a pump in the price. This area here, this portion of price action is called BPR, so balanced price range. All right. In a sense that we get a dump and a pump. Let me see if I can see an example. So here we have a pump and then a dump. All right. Most of you would be like, okay, where does it intersect? Both of them. Where does both FEGs intersect? Well, actually, there isn't any here right now. Let me find a better
I
example.
think your screen's frozen, brother.
How long has it been frozen?
It's been a minute, I think.
Oh, damn. Why does it do that? Why don't you write? Why? Come on, please tell me. Ah, why does it do this? Hold on. What if I go up? Can you guys see my screen now?
It's not moving.
Still not moving. Okay.
Same as before.
So, all right. Can you see my screen now?
Yes.
Good now.
All right. Now?
Looking good.
All right. Awesome. So what I was explaining in the last portion is our trade. So let me just, yeah. So here we had multiple entries that we could have took. I'll start with our strategy. So we have sweep, charge, FEG. We enter at the FEG, continue up. I was talking about institutional order flow entry drill, which means just tapping into the FEG and then moving from there. Also, we have a low, lower low, higher high. So this high screen candle is our breaker block. Extend it forward in time, you would see that this FEG is inside this breaker. So this is called unicorn entry, and unicorn entries are the strongest entries you can get in the market. And so that was a beautiful trade. I think most of you took it with me. Also, you might be asking, look, why did you choose this low, not this low? Well, because I'm checking what is near me right now. This is the lowest low near me. So low, lower low. This is the high, the green candle in between is my breaker block. Well, when we reach here, then on a bigger scale, low, lower low, higher high. So this green candle becomes our breaker block. Okay, it never touched it; it just continued going up. But there was an FPG as well. So if we tapped into it, that would have been your entry if you're late to this game. over here. Now, I'm going to be explaining market making models in a second, but that was the first thing. So that's our strategy, okay? Another way is we have lows, right? We have multiple lows, high time frame lows. The market just went below it, took out the liquidity, and immediately it showed order flow. It showed a rejection. What I mean by rejection is immediate displacement. This here is not displacement. This here is not displacement. This is displacement, okay? It's so fast, so aggressive. It just pumps up, leaving FPGs behind. This is your first sign of displacement, okay? Now, so what we can do here is, of course, this here is an order block. So when we sweep something, an immediate rejection up, displacement up, and then forming of course a charge, this here is a turtle soup. So you can have an entry somewhere around here. So what would you do normally is we took a big liquidity pool, we sweep. Forget about the sessions for now. Forget about the session. We have a big liquidity pool right there. Okay. We took it out and we showed immediate displacement up. Could you mute your mic, please, whoever? All I don't know is talking, but yeah, you show immediate displacement up. Okay. This here is your first sign. Now you want to see, is this actually just a retracement or is it actually a movement? How do you recognize the difference between the two? Well, you will check order flow. Okay, what do I mean by order flow? Order flow is something you check on the DOM, level 2, what else? Footprint, bookmap, blah, blah, blah. All these stuff, they're just there to make you pay extra. And if you're sitting in a cafe like paying, to just make you look, like, oh, I'm a pro. Look, I have so many things on my screen just pumping. But and they show you the direction. Like there's a lot of orders to be filled, to be eaten at the top. Well, we know that already because we set previous sessions. 2, we took the liquidity, delta liquidity. So now we're looking for higher prices. Okay, you don't need a tool to tell you that. You would know that already. What those tools show you, they show you order flow, not institutional order flow. Please underline this fact. It is order flow, not institutional order flow. Institutional order flow is what? Institutional order flow is based on the context, narrative, and the bias, and we will be able to determine where the prices are likely to go. And first, we would look for stuff that support this idea. So here, while we are somewhere around here, we expect a rejection at this point. Did we get it? We got it very nicely. So after this point, okay, that was our first idea, but that's not enough to take along. What's the second idea? The second thing you must always do is you want to see bullish order flow, institutional order flow, and bearish one to be disrespected, or bullish one to be respected. So here we have a bearish FVG, right? And this repeats every day and on any time frame. You can do it on 15 seconds. Here we have a bearish FVG. After this displacement, it was so aggressive, it was so good that we closed even above this one. So that's our second idea that, okay, we're starting to disrespect bearish order flow. And in return, that's the second tip. Third thing, we formed FUGs, which is nice. It's always good to form FUGs. But the third or fourth, I don't know how you want to number it, is how you can determine order flow is this red candle, this is the lowest red candle, when price closed above it, right here, this becomes an order block. An order block is not a block of orders, it's just a reference point for the algorithm. What that means is it is just a reference point. What it means actually, an order block is the change in the state of delivery. You want to see us change in the state of delivery of the price. So we were bearish. At this point, we flipped from bearish to bullish. Okay, we changed the state of delivery. So now we have the displacement up, we have the rejection, we have displacement up, and we're starting to show disrespect of bearish momentum, and we have institutional order flow starting to form in terms of the delivery, the state of delivery being changed. Okay, this point now we can be very likely, we can anticipate. Okay, bullish order flow has started. It has started. Okay, so now you want to see, but that's still not enough. You want to see, is it being respected? Okay, is this bullish order flow being respected? Okay, how do we do that? Well, as soon as we did this, we formed an order block. Price To see if you respect it, we have to see the price come back to it and touch it, okay? And see if it holds, especially the high, the low, and the midpoint. Mostly the high and the midpoint, okay? The lower portion is not important because below the midpoint, anything if we close below the midpoint, that means it's not being respected, okay? So right here, we formed that, but we started to form institutional order flow, okay? Now, this kind of pump, and of course, when this candle closed, we formed FVGs. FVGs with an order block makes this order block a high probability order block, okay? FVGs with an order block is equal to high probability order blocks, okay? Now, you might be saying, look, why did we choose this? Why didn't we choose this one or this one? Well, this is the lowest red candle before we had the change in state delivery. So this is the real order block. However, this red candle here is consecutively red, right? It's not red, green, red. It's red, red. So you can use both of them when right here, it's not an order block. When price closes above the high of this red candle, this also becomes a part of this whole order block. So you can what's the high of this candle? 49.59. This here is a signature. This is perfect. This is perfect delivery of price. Okay, it buying selling pressure doesn't do this. This here comes back here. Okay, so people might be like, oh, this is resistance stand support. No, if this is resistance support, then price should close here, not here. Once, what's the low of this candle? 49.59. What's the high of this candle of this order block? 49.59. Twice. Is that random? No, this is 5-minute candle. So in 10 minutes, we managed to make same lows in 10 minutes. So that's, I don't know how many, that's 10 minutes. I don't know how many candles that is in. Yeah, that's 10 candles in 1 minute time frame, right? So this shows you, okay, now we're really respecting bullish order flow. And of course, we have an FVG, which we will be entering anyway, because we have a sweep short FVG. This will be our entry. But so that's why the beauty of the strategy is that whatever I'm doing here, you don't have to do it. You just wait for the strategy to do it for you, because when you get the setup ready, it means all the things that I've just mentioned are already taking place. Now here, price came back here, you got tapped in, zero drawdown, stop loss, just below any FVGs. So here is an order block. You can put your stop loss either at the lows. If you can't handle it, you go with the smaller size, or if you can handle it but still want to take it, you can put your stop loss just below the midpoint of this order block. Why? Because if we close below the midpoint of this order block, we most likely can come back and revisit this low. Okay, most likely, because that means the bullish order flow is being disrespected. So this is here how we took the trade. Now, like I said, low, lower low, higher high. So this high screen candle is our breaker block. So we have a unicorn entry. So we have order flow, we have institutional order flow, we have order blocks, we have high probability order blocks, we have breaker blocks, we have FVGs, we have free trust FVGs. Like, it's a beautiful kind of entry. Okay. So what was I gonna say is yeah. So that was why this was a beautiful trade, and you can see the outcome, how much it went up. Now, here, this is our strategy. Now, what I'm going to be teaching you today is called market maker sell model. So it starts with an accumulation or a consolidation phase. Price moves away from this original consolidation. It's sometimes, but not always, comes back up to test the low of this original consolidation right here, and then it continues going down. It makes one more retracement, so it makes usually 2 retracements. 1, 2 before a big move. This second stage here is your best entry to go short. Okay, and then you can see you enter here, maybe at this FVG right there, and then you can see the big instant move down. So you can always forget everything and just trade this part, second stage of the market maker model. So here we have this, make it like a curve. We have sell side and another curve, similar curve, buy side. And what do you think we do? What's the point of the market maker model? The point of the market maker model is that we form the algorithm forms swing highs or swing lows that it can target later. Okay, it can target later on. What I mean by that, we have boom, we have a swing high, we have a swing high, swing high, swing high. So if you make a semicircle, once the price comes back here, it will reverse at there's something called smart money reversal, SMR. That is any higher time frame, liquidity, low of the day, high of the day, order block, FEG, any place where the market might want to reverse. So here we have this beautiful thing that we outlined, which is a pretty nice vision. Also, like I said, there's an order block here. And yeah, you see, oh, by the way, this right here is immediate rebalance. So look how much price went up. Anyway, back to our topic. Here at smart money reversal, you don't have to trade this. You can just trade in the other part because it always comes in two parts: sell side of the curve, buy side of the curve. Okay. When the money makes smart money reversal here, which I told you could turtle soup it once it goes below this low and get this rejection up, start disrespecting. You could be going long here. Okay, but this is hard for most of us to do. But after the smart money reversal, we are now entering the buy side of the curve. What that means is every single swing high we formed will become low resistance. So that now the market makers or the algorithm would bring the price up because if we on the buy side of the curve, and we will take out any swing high with really minimal resistance. Boom, we take this high up. This high, boom, we didn't reject a lot. Boom. And you will keep doing this. So we have only two in this our case, or three. So it's 1, 2, 3, 4. All of these can be UTPs, but you can hold a runner to the original consolidation. This market maker buy model will not end until the original consolidation has been taken. This is the high of it. This is the high of the original consolidation. So the market will keep in a buy model. So no matter how much you try to short, it will not short. Well, you might be like, well, if that does that mean if we get a short setup, do we take it? Well, you won't get a short setup. Price will not allow any structure change. You can see any? Nope. Did we get a bearish touch? Nope, we didn't. Price is continuing a buy model, buy model, buy model, buy model until we take the original consolidation out. Okay. After that, it can go pretty much a little bit more. How can you confirm that this is the original consolidation of the market making model? You will take it from this swing low. This is low, lower low. This is the high. Remember, it's our breaker block. This low, lower low. This low manipulated this low. So you can take it from this low, put it at this high. And if I'm right, we should get 2 to 2.5 exactly at the original consolidation. Is our original consolidation within the 2 to 2.5? Yes, it is. So while you're here, you can be sure you can leave a runner to go up here because the buy model will not stop until it goes here. This confirms our bias and confirms that this is a market making model anyway, right? And you might only realize while you're in this side, right? So you can take any buy opportunities and continue up. So while most of us will be like taking a long here, maybe getting out of this swing high or this swing high, no, you can be entering, and it's not a breakout entry. So let's say if this price just went a bit down to this XG, I can be going up, I can be going long here, while others will be like, oh, this should be our target. It could be your target if you're already here, but if you're not in a trade, you can take this trade and then continue up. You can take another entry position here. This is again FAG, the social order fluid right there, and then you can target this point here. Okay. Now, let's have 3 on here and see what happens. Yeah. So this is really powerful. It happens any time frame. Depending on the time frame you look at, it will happen multiple times in a day. If you look at a high time frame, it might happen once a day. Or if you look at session wise, it might happen per session, per week, per month, per minute, per 15 second, whatever. Okay. This was a beautiful trade. So we had our market maker model, we had turtle soup concept, we had also our own strategy, sweep charge FTG, and we have everything that you can take along here. So taking along in here, if you don't remember the MXS or MXM, or if you don't understand it or the turtle soup thing, just stick with the strategy because it does that all for you. Okay. And if here we have order blocks, FVGs, Josh sweep, as well as breaker blocks. If you get stopped out, if you enter here and you get stopped out, believe me, there's not a better entry you can get in this market, right? You shouldn't be sad. And if it does, I promise you, it won't just be a wick to stop come through. It will continue down, maybe take out this low and continue going down. All right. So that was a beautiful, beautiful trade. So now you might be asking, why didn't the market close here at the high? Why didn't it reject exactly at the above the top part of the London, right? Well, the market it will go most of the time. It will take the high and continue a little bit more up. Okay, a few points up, most likely to take out some kind of any other high. So here we have an FPG, swing high. We took the liquidity and an FPG. This is the turtle soup down, right? This is a turtle soup down. It's not a market maker model, but it's a turtle soup down that you can take. While people are focusing here, you can be taking this area here. Now, you might be asking, why did price come back here? Oh, it took out the high. Oh, it took out the high. Nice, great. So it took FPG, took out the high. You can be turtle souping here. Where's the body closing? Here, right? Somewhere around here. You can have a little bit of drawdown and then going all the way back down. Okay. So now on the same thing. We have a high, higher high, lower low, right? So this high manipulates this high. So this is how you can anchor your standard deviations from this high, the manipulated high, that high that manipulated the other high and put it at the swing low. You would get one standard deviation to the tick. Price came back to the tick, and that's why this target right to the tick, and then market starting to go up. Okay, so we can do the same thing, and that's how I took my trades on NQ, and we'll have a look on that in a second. So same thing at this level when it comes to one and rejects with aggressiveness, we most likely come back to equilibrium of the range. Did we come back to the equilibrium of the range? Is this random? Nope. If we close below the 1, then we most likely come back to maybe 1.5 or 2. But we rejected 1, so that means we come back to 1. So that can be your scalp long. You can go and drop on the lower time frames, find yourself in a Fiji, maybe a top, even on the 15 second, and then target the equilibrium. This here is a beautiful move. From here to here is almost 10 points. So that's $500, right? With ease of mind. Also, this equilibrium, like I always tell you, equilibrium most likely is within an FVG. So when the market takes out liquidity, it will run to FVG to fill FVGs or equilibrium. Most of the time, they're two. So one bird, two stones. Okay, that was right there again. Okay. Now same thing, order flow. So right here doesn't mean you can take a long. Well, you can 30 super, but you will want to see institutional order flow. So here's red candle. When this price closes above it, this means that this becomes an order block. Okay. And that means we should support this red candle. What institutional order flow means is that red candles should support price up. Okay. So this is our red candle. Is it supporting price? Yes, all of them, all of the bodies closing below it. What about the midpoint? We closed a little bit below the midpoint. I don't like that. Okay. Look how we're still respecting it here and here. Okay. I don't like that. I don't want to see that. This means that this institutional or bullish order flow is not that strong. We shouldn't be seeing that. Okay, we should be respecting it. We're not respecting it. So this whole movement is just to go to equilibrium, maybe to accumulate more shorts, continue go down, take out the session, do the session low, right? Because we failed here. Now the market will come back here, and it makes sense because we came to one standard deviation, came back to equilibrium, and then we accumulate more shorts, go down. Now, remember we at our example here we had the bearish FVG. Where is it? Bearish FVG, and we disrespected it. Well, this FVG is still disrespected. Look at the bodies, the wicks do the damage. Look at the bodies. The bodies tell the story. All of them are finding it hard to even close at the midpoint of this FVG. Okay, they can break out. Why? Because there's equilibrium there and there's an FVG there. It's when did it go to equilibrium? Straight also to the midpoint of this FVG, but the body stayed here. Okay, so this here is an area where you should be trading. Okay, here we have an FPG. We're respecting this bullish FPG, right? But we expect that this bullish FPG to be disrespected because bearish order flow, especially order flow, is still intact, right? We're disrespecting bullish momentum, a bullish order flow. So that was nice. Let's go on NQ and show you what I did. I can remember. I wasn't the one behind it. So on entry, what do we have here? This lowest red candle is an order block, right? It's also it's a very it's a high probability order block because we have an FPG, we have another FPG. So you want to mark the opening price of this order block, also the midpoint of this order block. Okay, this is the midpoint. Whereas the bodies the wicks went down almost to the midpoint of this, but it couldn't come back to here because it's FPG, so it just went to this FPG, and the bodies remained at the open of this order block. Okay, they remained exactly there. They were holding there. So I was like, okay, nice. Now we're respecting a higher time frame PD array on order block. So we might expect we should look for some rejection up. If we get the rejection up, we can scalp along. So this is our order block. And yeah. So hold on, I tried to remember what I took the long. Okay. So here we had the rejection up. We started to respect this. We went down again. I don't know why I went long, to be honest with you, but I think it was somewhere here. Yeah, we respected it, and then we formed bullish momentum. We started to respect this bearish FPG. This candle closed above this red candle, so this becomes an order block. Are we respecting the order block? Let's have a look. Where's the midpoint? The midpoint is right there. This order block is right there. We respected it. Nice. That I'm saying bullish momentum, a bullish institutional order flow being respected. Then we went up from the FTG and closed above. We disrespected the bearish ones. So okay, I'm nice. I'm seeing some momentum, bullish institutional order flow being respected and bearish one being disrespected. Very nice. So and then as soon as we close above this candle, I took a long. I used this as an inverse. Of course, I was on the 15-second. We closed above it and then tapped it. I went long, and then I targeted just the midpoint of this bearish FVG. Why? Because you can see that this move was just most likely coming back down, touching just the mid, just trying to fill this imbalance to continue going down. Okay, that's how the market moves. And now what do we have here? Similar scenario. What are we gonna say? I took another long here. So once we came back down, I was expecting it to touch this midpoint, and I had a limit order to try to super up, but it didn't get filled. It immediately showed rejection up. Why? Because ES was also pumping back then, so both of them going in synchronous. They went up this candle here. It closed below this red candle. So bullish institutional order flow is still not there. So I didn't take my long here. I was gonna take it here, but I didn't take it yet. When did I take it? This candle closed above this red candle, so this becomes a bullish order block. Okay. Now we formed a small FPG, and I entered it on this FPG. And now another way to see institutional order flow is if we have wicks, we expect the midpoint of these wicks to be respected, and that's how high frequency traders will be trading. So you can see that market went up. Every time it goes down, I'm buying. Every time it goes down, I'm buying. Where am I buying? Most likely in the upper portion, about 75% or up to 50%. But my stop loss was right here. My stop loss was right there. I don't know if you guys see in the picture. And I added another contract here. Price continued up. You can see we have another wick behind. Price went, probably accumulated more orders. It went just a little bit below the midpoint, but it didn't close. You can see we don't get enclosed. So you could have added another one here. I didn't want to because I'm already over leveraged with 2 contracts. And at the same time, remember, you always check if bearish ones are being disrespected. Also, this is our 15-minute order block opening price. Remember this red line? Keep it in mind. So, so this bearish order FPG, we disrespected, closed above it. Now we used it as inverse. Okay, so we're disrespecting ones and we're showing bullish momentum. High frequency institutional traders are interested in buying here. And then of course we targeted. I had in my mind. We have an FPG here, and we have a big wick. So and people might be, whoever's trying to go along, maybe there might be one thing happening. They might have their stop, they have TP here, right? I'd never trust that. Whenever we see a big wick, we must take partial there, even if it's $10. I don't care. However much your risk to reward is, I don't care. When you see a big wick, you must take a partial. I had one contract on left, so I couldn't take a partial, but that means I have to close my trade right here on the midpoint. Price came back to the midpoint, and I showed you in the screenshot. I took my TP out here. 2 minutes later, the market crashed. Okay, the market crashed, and it didn't take out this high. This high still intact. This is how you get wrecked. This is how you make money. Okay, so that is a sniper entry. It's not a sniper entry. Sniper entry is someone who just, I don't know. I don't trust sniper entries, but I trust algorithmic delivery. So market's going up. I want to take my partial here. Okay, and I did, and thankfully, thank God I did, and the market crashed down all the way back to even when I was at break even, but I was already out of the trade. You know. And then the market is starting to consolidate between the two. So here is where you do, trading. So yeah, um, that's pretty much about it. So I think I wouldn't look for any longs until ES takes its lows. Look how many people would get wrecked here. We want to take out the lows to look to take any more longs, okay? Because prices at equilibrium within a Fiji. So now it should consolidate and then run to liquidity. Okay. We're approaching lunchtime, so maybe in the lunch macro for 11:50 to 12:10, we will run liquidity. We might take all these liquidity here. Now retails will think that this is a trend line, right? In ICT terms, it's a phantom trend line. So I would expect they'll be buying here. We would be targeting this. So when during the macro, I could presume that the market will go down, take out this liquidity, and continue going down to take out the equal lows or the midpoint of this wick. Or it will just come back here, take them out, and then continue going up. Okay, whatever the market's gonna do. This would be accumulation, manipulation, distribution, or it will be accumulation, distribution. Accumulation, manipulation of the highs, and then distribution down. And it makes sense to go down, right? Because we had everybody that was in shorts got wrecked. Now everybody's trying to touch the lows. Anybody who's long in, the market would like to take them out. So that's what the lunchtime reversal does. It tries to take out anybody that's in profit before the lunch. Okay, so keep that in mind for if you are gonna take a trade in a little bit. What was I gonna say? On CL, I took a trade, but I got stopped out. Got stopped out here this time. Because we had NWOGs, we had multiple NWOGs. The market went up to here. I was like, why would it go up to here? I allowed it to, but I can't handle that stop loss, so I got out of the trade. It went out here. And I promised you I was gonna go turtle sip here, but it went straight to the midpoint. Okay? Of this big NWG. And then it started to reverse. So here we had, of course, we had sweep, tosh, FPG, but if it went up here and it went down, okay? If in CL, I don't like trading CL because if it's stubborn to go down. If it shows it's stubborn to go down, it means it's gonna go up, and it's gonna go up a lot. Okay. And it's usually a single direction. Yeah, so it went finally to the midpoint of the NWG and then continued going down. Now it went down. Now it's the previous session high. Charge. FPG. Now this is currently what's going on right here. That was my TP, by the way. Yeah, my TP was high, low. So this high and one standing deviation. Just one takeaway from it. Anyways, so same thing right here. We have a high, low. This low candle is a breaker block. This is a beautiful short to go into PL. Okay, and you would target your first TP would be this one standard deviation. Okay, that's around $500. Okay, with one contract. And yeah, I'm not taking it. If you want to take it on paper trade. This is not institutional order. This is not institutional order file. This is not. It's not financial advice. Okay, but this is how you'll be planning your trades. I already have my TPs where I want to go up. You might be asking to go all the way down here. Nope. Maybe at this FPGs. Sure. Not this FPG. This FPG because this FPG is discounted. If I go from this low to this high, this FPG is on the premium. This one is discount, or both of them discount actually. So this one's near the equilibrium. You can see price came back here and respected it. But if we drop one more time, we'll probably come back to the heavily discounted and show some rejection there. Okay, and then maybe continue going down. But I'll go stop out on this. So I will not try to over leverage, not over leverage, over trade myself because there's always opportunities, right? So yeah, guys, that is about it. Do you guys have any questions, or did you find this useful, or a waste of time, or complicated? To be honest with you, whatever, there's many concepts. There's 81 different ways to enter the market. Sorry, 83 different ways to enter the market. Just use the sweep, chosh, FEG. Okay, like even on the longs in the morning, you have sweep, chosh. Well, nope, you have an entry. On ES, yeah, nothing pretty much. What about this? We have a sweep, chosh. We enter here, go down. Is there an FEG here? This is immediate rebalance. This means the market will go far and fast. Boom. Okay. On NQ, this last trade I took, there was also this candle going up. It was looking like an FEG. This candle, if it closed, if it left some portion of this candle open, it would have been an FEG, right? But it didn't. It went down, touched the star of this candle to the tick, you see? To the tick, the body, opening price, and it went back up and closed near the open, near the close of this candle. Okay, this is immediate rebalance. So this means the market will go up fast, fast and fast. Boom. Okay, that was another confirmation I had on my chart. Now, if you find all these complicated, there are many. Like I said, there's 83. Find the one you're comfortable with. Find the ones you're comfortable with, and then take it. Well, we just saw every single time we have sweep, tosh, FEG, and then you just target the previous session high, okay, or the previous session low. It does all the stuff you need to do. You don't have to wait for suitability. You don't have to wait for blah blah blah. It just does it for you, right? Because it means the market is already primed to continue going up because we took the liquidity. Sweep means we took the liquidity. Tosh means we're changing the direction or state of delivery of the price. And of course, if we form a torch, that means we broke above any red candle and their respected FEGs. So you just have a sort of order flow with you, and you can ride it up. If you're able to notice that this is origin consolidation, then you can hold all of it. If you do not recognize it, then you will take partials at every swing high and every big wick, as we saw on NQ. Yep, that's about it, guys. Hope one of you recorded. It was useful. Let me know. I haven't done these in a long time, but they're useful stuff, and they repeat every single night. And you see, if you miss out one of the concepts, there's 5 other concepts that we could have gave you the exact same interest and even better earlier entries, earlier discount. So, all right, guys, peace.